Well, good morning. This is Michael DeVille coming to you from beautiful Phoenix, Arizona. Today is October 6th, 2020. Tatum and I are in the incredibly scrumptious offices and studios of West USA, and we're going to be talking about some financial topics today. Now, on this webinar, you're welcome to look in if you have some questions coming along. I'm going to be very, very conscious of your time. This should run about 21 minutes. If we have a chance to answer questions, we certainly will. Tatum will be monitoring this. And of course, we'll try and get this up onto YouTube later this afternoon so that you can send it out to your clients and review it yourself. Now, you know that I give this is my opportunity to give back to you guys because this industry has been so wonderful for my family. It has just provided extremely well. We've been able to do things that we probably wouldn't be able to do if I wasn't in the real estate business. And I'm giving back to you. I'm here to help you create a real estate money machine that's going to provide income for you and your spouse and your kids and your grandkids. It's going to keep giving you income for generations. And this is what we're going to build together. We're going to talk about some financial topics. We're going to talk about depreciation today. But next week we're going to talk about something about tax deferred 1031 exchange. Then when we talk about depreciation rolls right into the 1031 exchange because once we fully depreciate a building, we have that option to do a tax deferred 1031 exchange. And it's just the perfect segue to next week. So make sure that you stay with us for next week. So onward to the next one. We're going to talk about depreciation today. Now, before we get into depreciation, we're going to talk about why does the government give us such a great tax advantage. We talked about depreciation being one of the 6 ways a real estate investor makes money in real estate. Depreciation is certainly one of them. It's a tax advantage real estate investment for ourselves. And depreciation, just think of this. We're going to get into this. Just think of this, that the government allows you to depreciate the entire cost of the structure of that property off your taxes over 27 and a half years. So the entire value of that building is taken off your taxes as a deduction over 27 and a half years. And you have to say, this is a wonderful thing. Why does the government do this? Because if I've done my job well, your taxes are going to be dramatically and incredibly reduced, and the government's not going to get this money. And if I do a really, really good job, I'm going to get down where you're paying no tax. So why does the government do this? Well, the government does this because they want to incentivize a real estate investor. They want to incentivize a real estate developer to deploy capital where the country really needs it. Keep in mind here in Phoenix, just the average rental, we need rentals here in Phoenix because we have a shortage. The government and the Congress writes these tax laws to incentivize us to do these things. And just think how much this is provided just by the standard real estate transaction. Think of all the people that are paid and are involved. So not only do you have the real estate agents and the sellers getting paid, you've got the appraiser, you've got the inspector, you've got the people who are doing repairs on the BINSR, you've got the title people, you've got the escrow people, you've got the lenders, you've got the home warranty, you've got underwriters, you've got just tons and tons of people who are getting paid. And of course, this is revenue for all these people and they're getting paid. This is why we as real estate investors get incentivized to give this to the economy because it's just a great boost to the economy. And for us, it's a way for us to provide housing. And of course, not everybody can afford housing. And of course, not everybody wants to buy housing. They don't want to be responsible if the roof goes bad. They just want to call their landlord if the air conditioner needs repair. They just call landlord. They don't want to be responsible for it. And as real estate investors, we provide that service and, of course, the housing. This is very, very important. So Don't feel bad about it. If when I get your taxes down to almost nothing, if you feel bad, you can still send a gift to the Treasury and say, look, I feel really bad. I'm going to send you $50,000. So let's go on here. So we're talking about depreciation. What is the definition of depreciation? How is the amount of depreciation determined? We're going to talk about that in just a second. How does depreciation maximize your cash flow and your overall cash on cash return? Well, we're going to talk about that very, very quickly here. And this is going to be one of the most important segments that you watch. So pay attention. So what is the definition of depreciation? Depreciation is the recovery of the property over a number of years. This is an IRS. So the IRS allows us to take this property and depreciate it over 27 and a half years over the life. Now, I'm going to tell you that at 27 and a half years, you've fully depreciated the building. You've taken the entire cost of that building off your taxes. And I'm going to tell you, I own properties that are way older than that. I've owned them for 30, 32, 33 years, 34 years. They're just doing fine. They're in perfect condition, but I've had all this tax benefit for all these years, and the building is just fine. But this is just the tax incentive. So how is the amount of depreciation determined? Now, I want you to pay really, really close attention to this. Now, you cannot depreciate the land. So if you're buying a ranch or you're buying a farm and you spend $1 million for a farm and it comes with a farmhouse on it, you can't assume that most of the value is in the farmhouse and start depreciating the farm and say, well, I paid $1 million for the property, but the farmhouse was $850,000 of that. So if the economic use of that land, you probably need to talk to your accountant and try and figure out what the really cost of the land is, because we cannot depreciate land. That's always going to be there, but you can depreciate the structure. If you talk to your accountant, I've seen it between 10 and 20% for the normal transaction. So if we buy a house for $300,000, what is the cost of the lot for building that house? I see that between 10 and 20%. Talk to your accountant to see what works best and be logical about that. But the standard lot, if you bought a standard house for $300,000, I use 15%. That seems to work pretty close. I think that's a pretty standard price. So if you buy a $300,000 house, that lot cost is going to run you about $45,000. And that's not going to be depreciable. But that leaves you $255,000 that you're going to depreciate off your taxes for the next 27 and a half years. The government is giving you a $255,000 deduction for the next 27 and a half years that you can take that. So we've put the numbers on here. So let's just go through the example on this. So if you purchase for $300,000, we take out 15%, $45,000. We have $255,000 of depreciable structure. And that gives us $9,272 per year deduction on that property. And now that runs for 27 and a half years. That means that the first $9,200 of cash flow to you comes to you tax-free. Tax-free. And you know, here in Arizona, we're going to be looking at if you have a free and clear property, after everybody gets paid, by the time you pay your property manager, you pay your taxes, your insurance, your HOA, we want to put a escrow, we want to put a repair escrow in for things that break. You know you're going to net at least $1,000, sometimes $1,200 a month. So if you're earning $12,000 a year on your rental, $9,200 of that comes to you absolutely positively tax-free. Now, how cool is that? So how do you maximize your cash flow and overall cash return? So let's just talk about this. I'm going to give you two examples. Now, this happens all the time. So let me just say that oftentimes I was sitting down with real estate agents, and in our business, if you've been in business for a little while, you easily make $180,000. That's really only maybe 15 to 20 sales a year, less than 2 sales a month. We're going to be looking at $180,000. Or you could be a plumber. You could be a hairdresser. You could be an engineer. You could be working in a software company earning $180,000 a year. Now, these are actual figures. So if you have $180,000 a year in income, your total taxes are going to be $52,500. $52,500 you're going to pay in taxes. Now that's federal taxes, Arizona tax, Social Security, and Medicare. Now keep in mind these are all sliding scales. So the more money that you have as a taxable income, the more money you pay. So if you can reduce that income on a sliding scale, all four of those are going to be reduced. Now, I'm going to tell you that if we have $180,000 and you have 10 properties, now you know that's just my arbitrary goal for you is to have 10 properties. If you're making $180,000, you should have 10 properties. And 10 properties at $9,200 a year for depreciation is going to give you better than $92,000 a year in deduction. So if you're taking $180,000 less than $92,000, we've reduced your taxable income to $87,000. So at $87,000, you're going to have your standard deduction. If mom and dad, they get a deduction for, I think it's $24,000. So we're going to reduce that taxable income from $180,000 down to $62,000. And I'm going to tell you, if you still have $62,000, I would be jumping up and down telling you need to get that other $25,000 into a qualified plan for yourself. KEO, a SEP IRA, a qualified IRA, maybe do a Roth, but we want to get you into some kind of where you're getting your reserves in some kind of qualified plan, and again, reducing this off your taxes. So we can easily get this down to where your taxable income is down around $37,000, and you're going to be paying a total taxes. Now that's total taxes, Medicare, Social Security, state tax, and federal income tax of about $6,500. So we can easily reduce this down from $52,500 down to $6,500, and that gives you a savings of almost $46,000. $46,000. Now let me ask you, how much down payment do you need for a $300,000 rental? What's 20% of $300,000? $60,000, and you just saved $46,000 on your taxes. Uncle Sam has almost given you enough money for your next rental. This is such a wonderful, wonderful benefit we have, and this is one of the 6 ways you earn money owning real estate, rental real estate, and we're earning a cash flow that you can't get anywhere else, and you're getting this off your taxes. If you come in and see me, you can talk to your accountant, talk to your financial advisor. It's not like this is magic, and sit down. We can get it down to where you're paying absolutely almost next to no taxes at all. It's not like we're deferring them. You just don't have to pay the taxes because you've gotten a legitimate deduction. So what happens if you're a baby boomer and you're living on your income? What happens then? So what happens when you're going to depreciating your cash flow and overall return and you're a baby boomer? Here's what happens. You know, if you have 10 properties and you're getting $1,000 a property, you're taking in $120,000 a year in income easily, and it's growing each and every year for yourself. So if your income's $120,000 and we're going to depreciate, we're going to take the depreciation on 10 rentals, and that's $92,720. Now you'll have these if you want this. It should be on your flyer. We can make sure that you get this as a jogger. It's going to be on the. I know we're doing these numbers, so it's going to be up on YouTube so that you can look at these and you can recalculate them, because maybe I'm going a little fast on this, but it's going to be in black and white. But if you have $120,000 and we have $93,000 in depreciation, you're going to get your taxable income down to less than $28,000. We're down to $27,280. Mom and dad get to take their standard deduction of $24,800. Your taxable income is $2,480. You're not going to pay any tax whatsoever on that. So you can earn $120,000 in income, 120 grand in income, and not pay any tax whatsoever. Zero. And of course, if you follow our strategy, if you're mom and dad and you're retired, you've got this $120,000, your house is paid for, your cars are paid for, you're out of debt with your credit cards, you've got reserves built up, and you're getting this $10,000 a month. And how much of that $10,000 a month can you spend if your house is free and clear, if we're not paying taxes, if your cars are paid for? You have a lot of spendable income, and you can do all kinds of things with them. You can take your kids on Disney cruises. You can take your sweetheart and go learn to cook in France. You can go dive the Great Barrier Reef because you have planned, and this will work for you. And that's my job. I'm here to help you learn how to do this stuff so we can get you free, get you some tax reserves, get you some, and build up a 401k for yourself and an IRA, and have plenty of free income coming in each and every month. Now, we're going to talk about next week, because once we're in a property for 27 and a half years, it's fully depreciated. Our tax advantage goes away. Now, I own properties that are fully depreciated because I have families living in them. They've been living in them for 15 years. I could go ahead and sell them and restart the depreciation, which is what I would tell you to do. It's just that these folks, this is their home, so I don't want to disrupt them. But I've done this on many other properties. So what you do is when we have 27 and a half years, we sell the property, but we really don't sell, do we? We trade the property through a tax-deferred 1031 exchange. We don't have a taxable event, and we can restart that depreciation clock for ourselves and start this 27 and a half years over. Next week, we're going to talk about the 1031 exchange and teach you how to do it. It's so simple to do. I've done it hundreds of times, and it's so easy. There's just some rules. You just follow the rules, and if you follow the rules, everything gets done. So I want to tell you, we're going to put this flyer together for you. If you email to creatingwealth@westusa.com, we'll send you out this flyer. We're also going to have this YouTube, so you can pair these two together, but you can send a flyer to your clients. You can send a YouTube to your clients. If you want to call us, you're welcome to call me at the office, here at corporate, 602-942-4200. If you have any questions for me, Tatum and I will be looking for this, and we'll try and answer that on the podcast on Saturday. We do a podcast on Saturday, and we get a lot of questions during the week, and we will bring those questions as well. But you're welcome to send those questions to creatingwealth@westusa.com. If you'd like to sit down and talk with me, keep in mind we brainstorm. You guys know a lot of this stuff. You guys know a lot of this, so it's not like I have to reinvent the wheel, but I'm more than happy to help brainstorm with you and guide, and we can do some goal setting for you. You're welcome to reach me at creatingwealth@westusa.com. Now, I have room for maybe 5, maybe 7 more attendees for the workshop. Now, this is a beta test that's coming out next, it's 2 weeks from Thursday. I have room for about 7 people. It's going to be all day. If you have any interest in doing that, please email to creatingwealth@westusa.com. So I'm going to try and be very, very conscious of your time. This is it was an interesting topic. If you have any questions whatsoever, you're welcome to give us a call. And I want to wish you the very, very best. My best to you. Bye-bye now.